There is a number sitting in your retirement plan right now, and it is quietly lying to you. The number is $6,000 a month. You worked it out somewhere, on a napkin, in a spreadsheet, or in the back of your mind on a slow afternoon at work. $6,000 a month. $72,000 a year, enough to cover the house, the groceries, the car, the trips you kept putting off. Enough to finally stop counting every dollar. And on paper, it is enough. But here's what almost no one tells you before you hand in your badge. That $6,000 is a gross number. It is the number before the IRS walks into the room. And the IRS does not wait politely at the back of the line for its share. It goes first. Before that money reaches your checking account, before you pay the electric bill, before you buy a single bag of groceries, the IRS has already decided how much of your $6,000 is actually yours to keep. Most retirees never run this calculation. They build their entire retirement on the gross number, the big friendly number on the statement, and then they spend the first 2 years quietly confused about why the money does not stretch the way the math promised. The gap between the $6,000 you think you have and the amount you actually get to spend is not one tax. It is a stack of them. Some of them are obvious. Some of them are hidden inside your own Social Security, taxing money you already earned. One of them depends entirely on what state your mailbox sits in, and one of them is sitting on a timer, set to go off at the end of this decade, that will quietly take more from you starting in 2029. Today I am going to walk you through exactly how much of your $6,000 month survives contact with the IRS real numbers, real 2026 rules, and by the end you will know the one figure that actually matters. The figure your statement will never show you, not what you make, what you keep. And before you decide this is only for people with big pensions or seven-figure accounts, let me stop you right there. It is not. Whether your $6,000 comes from Social Security, from a pension, from an IRA, from a 401k, or from all of them stitched together, every single mechanism I am about to show you applies to you. The retiree living on exactly $6,000 a month is in a lot of ways the most exposed person in this whole conversation because they have the least room for a surprise. Now before we go any further, the honest part. Everything in this video is for educational purposes only. I'm not a lawyer, I'm not a CPA, and I am not your financial advisor. What I am going to give you is the math and the rules laid out clearly so you can ask sharper questions and stop being caught off guard. Your situation has its own details, and those details matter, so always check your own numbers with a qualified professional before you act. If that is the kind of straight talk you have been looking for, do me one quick favor and tap the like button. It genuinely helps this channel reach other retirees who are about to get blindsided by this exact thing. And if you are not subscribed, subscribe now because I break down one of these hidden retirement tax traps every couple of days, and the next one might be the one that saves you the most. Alright, let us meet the first taker. The first thing the IRS does, before income tax, before anything, is decide how much of your own Social Security it gets to tax. I want you to sit with that for a second, because it is one of the most misunderstood rules in all of retirement. You spent your entire working life paying into Social Security. Every paycheck a piece went to the system. That money was already taxed once on the way in, and now in retirement, the IRS reaches back and taxes a large part of it a second time on the way out. Most people assume Social Security is tax-free. It used to be for everyone decades ago. Not anymore. Today, depending on your other income, up to 85% of your Social Security benefit can be pulled into your taxable income. Here is how it actually works, in plain words. Because the rule hides behind a piece of math the IRS calls your combined income or your provisional income. To find it, you take all of your other income for the year, your IRA withdrawals, your pension, your interest, any work income. Then you add 1/2 of your Social Security benefit on top. That total is your provisional income, and it is the tripwire. For a married couple filing together, the first tripwire sits at $32,000. Cross it, and up to half of your Social Security becomes taxable. The second tripwire sits at $44,000. Cross that one, and up to 85% of your benefit is on the table. Now here's the part that should make you sit up. Those two numbers, $32,000, $44,000 for a couple, have not moved in over 30 years. They are not adjusted for inflation. They were written into law back when $32,000 was a comfortable retirement, and they have been frozen ever since. So every single year, as benefits rise with the cost of living adjustment and prices climb, more and more ordinary retirees get dragged over those lines. The tripwires do not move. You move toward them automatically, whether you like it or not. Let me make this real with a couple. I am going to use them all the way through this video, so picture them clearly. A married couple, both 66, both retired. Between them, they bring in exactly $6,000 a month, $72,000 a year. It breaks down like this. $30,000 a year from Social Security, the two of them combined. $30,000 a year from a traditional IRA and an old 401k, and $12,000 a year from a small pension. Add the IRA and the pension together, and that is $42,000 of non-Social Security income. Now add half of their $30,000 in benefits, which is $15,000. $42,000 plus $15,000 gives a provisional income of $57,000. $57,000 is well above the $44,000 second tripwire, so they are squarely in the 85% zone. When you run the IRS worksheet on those numbers, about $17,000 of their Social Security gets pulled into their taxable income. Read that again. They receive $30,000 in Social Security. $17,000 of it just became taxable. More than half of a benefit they already paid for taxed again, simply because they also dared to withdraw from their own retirement account in the same year. That is the first thing the IRS takes. Not a dollar amount yet. It takes the protection off your Social Security. It turns a benefit you thought was safe into ordinary income, and it does it before you have calculated a single thing. This mechanism even has a nickname among the people who study it. They call it the tax torpedo because of how it works. Every extra dollar you pull from your IRA does not just get taxed itself. It also drags more of your Social Security into the taxable pile right alongside it. So $1 of withdrawal can cause far more than $1 of new taxable income. The torpedo is quiet, it is legal, and it is aimed directly at the careful retiree who is just trying to live on $6,000 a month. Let me show you the torpedo in slow motion, because once you see it, you cannot unsee it. Imagine our couple needs an extra $1,000 this year for a car repair, so they pull $1,000 more out of the IRA. You would expect that to add $1,000 to their taxable income. But because they are sitting in the 85% zone, that $1,000 withdrawal also makes another $850 of their Social Security taxable. So a $1,000 withdrawal creates $1,850 of new taxable income. The dollar you pulled out brought a passenger. That is the torpedo. It means the real tax cost of touching your IRA in retirement is often far higher than the bracket on paper suggests, and it is the single most overlooked force in retirement tax planning. And remember why this is getting worse for everyone, not better. Those tripwires, $25,000, $34,000 for a single person, $32,000, $44,000 for a couple, were set in the early 1980s and the early 1990s, and they were never indexed to inflation. When they were written, only a small slice of wealthy retirees ever crossed them. Today, a couple with an average benefit and a modest IRA sails right past them. The lines have stayed perfectly still for 40 years while the world got more expensive around them. That is not an accident you can fix. It is simply the design, and it means more of your Social Security becomes taxable every single year you stay retired, with no action required on your part at all. Now here's my first question for you, and I read every single one of these. Before today, before you press play on this video, did anyone ever sit you down and warn you that your own Social Security could be taxed a second time by the IRS? Type yes or no in the comments. I am genuinely curious how many of you were told, because in my experience, almost no one is. Alright, we have seen the first taker reach in and strip the protection off the Social Security. Now let us actually total the bill. Let us see what the IRS takes in plain income tax, and the answer is going to surprise you, because it cuts both ways. Back to our couple. We left them with a provisional income calculation that made $17,000 of their Social Security taxable. So now we build their adjusted gross income. $30,000 from the IRA and pension. Wait, let me be precise. $30,000 from the IRA, $12,000 from the pension, and $17,000 of now taxable Social Security. Add those together, and their adjusted gross income lands at about $59,000. Now this is where most retirees stop. Look at $59,000 of taxable-looking income, panic, and assume the IRS is about to take a brutal cut. And this is exactly where the picture flips, because in 2026, the deductions for people over 65 are unusually large. Watch what comes off the top. For a married couple filing together in 2026, the standard deduction is $32,200. Then, because they are both over 65, they each get an additional standard deduction of $1,650, which is $3,300 between them. And then there is the new one, the piece that is doing a lot of quiet work right now. A temporary senior bonus deduction of $6,000 per person for people 65 and older. For the couple, that is another $12,000. Stack them up. $32,200 plus $3,300 plus $12,000. That is $47,500 in deductions before they have done a single clever thing. So we take their adjusted gross income of about $59,000 and we subtract $47,500 in deductions. That leaves a taxable income of roughly $11,500. $11,500 sits entirely inside the lowest federal bracket, which is 10% for a couple. 10% of $11,500 is about $1,150. So here is the honest headline, and I am not going to dress it up to scare you, because that is not what this channel does. In 2026, a married couple, both over 65, living on $6,000 a month from a normal mix of Social Security, a pension, and an IRA, pays only about $1,150 in federal income tax for the whole year. On $72,000 of income, that is an effective federal rate of under 2%. And I want you to understand why, because the reason is the most important planning insight in this entire video. Their tax is low, not because their income is low, but because the deductions available to people over 65 in 2026 are the most generous they have been in a generation. 3 layers are stacking on top of each other at the same time. The regular standard deduction, which is already large, the extra over 65 amount, which most people forget exists, and the brand new senior bonus deduction, $6,000 per person, which was created only recently and did not exist a couple of years ago. $47,500 in total deductions means a couple can have nearly $60,000 of income before they owe Meaningful tax that is a wide, generous shelter, and right now today you are standing inside it. There is one more thing you have to understand here, the difference between your bracket and your real rate. Our couple is in the 10% bracket, but their effective rate, the share of their whole income that actually goes to the IRS, is under 2%. People hear the word bracket and panic, thinking the IRS takes that percentage of everything. It does not. It takes it only of the slice of income that lands inside that bracket after every deduction has come off the top. That distinction is the difference between fear and a plan, and the retirees who understand it sleep a lot better. Now you might be thinking, well, that is wonderful, the IRS barely touched them, what is the problem? And if I were a dishonest creator, I would stop the video right here and pretend the danger does not exist. But that low number is not a gift, it is a trap, and I am going to show you the 4 reasons why, because every single one of them takes that comfortable little $1,100 tax bill and turns it into something much larger. The favorable number you just saw only exists for one very specific person, in one very specific year, in one very specific state. Change any one of those 3 things and the IRS takes far more. Before I show you how, this is the right moment to mention something, because it solves the exact problem this video is about. Running these numbers for your own situation, with your own pension, your own benefit, your own state, by hand is genuinely hard. So I built the Retiree's AI Research Guide. It walks you through how to use AI to answer any retirement tax question for your specific situation, the way I just did for this couple, but with your real numbers. The link is in the description at kevinretires.shop, and to be completely clear, it does not replace a good accountant or financial advisor, and it is not meant to. It just helps you walk in already knowing the right questions. Okay? Reason number 1 that the low number is a lie, the person left on their own. Our couple paid about $1,100 because 2 things were protecting them. 2 standard deductions, 2 senior bonus deductions, and a set of tripwires set higher for couples. Now imagine that one spouse is gone, and the surviving spouse is living the next chapter alone. Everyone assumes that when you go from 2 people to 1, your taxes go down, because there is 1 less person and usually less income. It is one of the most expensive assumptions in all of retirement, because the opposite is true. The surviving spouse very often pays more tax on less income. This is sometimes called the survivor's penalty, and it is one of the cruelest pieces of math the IRS has. Here is why. The surviving spouse keeps the larger of the 2 Social Security benefits and gives up the smaller one. So household Social Security drops, let us say, from $30,000 to about $20,000. The pension might be reduced too, or it might continue in part. But the bills do not fall by the same amount. The home still costs what it costs. So the surviving spouse still needs to pull a similar amount from the IRA to live. But now everything is calculated as a single filer, and the single filer gets cut down at every step. The Social Security tripwires for a single person are not $32,000 and $44,000. They are $25,000 and $34,000. Lower, easier to cross. The standard deduction is not $32,200. For a single person, it is $16,100 half. The extra over 65 amount is a single $2,050 instead of 2. And the senior bonus deduction is $6,000 for one person instead of $12,000 for 2. So let us run it. The surviving spouse, single 66, brings in about $20,000 of Social Security, $30,000 from the IRA, and $6,000 from a reduced pension. Their provisional income lands around $46,000, which is far past the single person's $34,000 tripwire, so they are also in the 85% zone. About $14,700 of their Social Security becomes taxable. Their adjusted gross income comes to roughly $50,700. Their total deductions as a single person over 65 are about $24,150. That leaves a taxable income of about $26,500. And now they climb into the second bracket. The first portion is taxed at 10%, the rest at 12%. The federal tax bill comes to roughly $2,900. Stop and compare those 2 people. The couple, on $72,000 of income, paid about $1,100 in federal tax. The surviving spouse, on only $56,000 of income, pays about $2,900. Less income, nearly 3 times the tax bill, more than double the effective rate. That is the survivor's penalty, and almost no one sees it coming because the system is not built to warn you. The IRS does not send a letter that says, by the way, when there is only one of you, your rate is about to double. It simply happens quietly in the first tax season after a household goes from 2 to 1, and here is the cruelest part of the timing. All of these changes land in the same year on top of each other. The household loses 1 Social Security check. It very often loses part or all of a pension. And at the same time, the tax return flips from the wide married brackets to the narrow single brackets, with half the standard deduction and half the senior bonus deduction. So income falls and the tax rate rises in the exact same 12 months. The surviving spouse is living on less money and handing a bigger share of it to the IRS during what is already the hardest year of their life. The math does not care about the timing. It just executes. This is also why planning for it has to happen while there are still 2 of you. Once a household is down to 1 person, most of the best moves are already off the table. The window to do something about the survivor's penalty is now, while both brackets are still available, while both standard deductions still apply, while there is still room to move money into a Roth and out of the reach of those narrow single brackets forever. Waiting until the penalty arrives is waiting until it is too late to do much of anything. So the comfortable $1,100 number from the couple was never a permanent feature of living on $6,000 a month. It was a feature of being two healthy 66-year-olds in the same year. The moment that changes, and for most couples it eventually does, the IRS takes a far bigger first cut. Reason number 2 that the low number is a lie, your state. Everything we have calculated so far is federal. It is the IRS, but the IRS is not the only one with a handout, and this is where your zip code quietly decides your fate. Some states do not tax retirement income at all. A handful have no state income tax whatsoever. Several others specifically exempt Social Security, or pensions, or both. If you happen to retire in one of those states, the federal number is close to the whole story, and you keep almost all of your $6,000. But other states tax your retirement income on top of the federal bill. Some tax your IRA withdrawals. Some tax your pension, and a few still reach into your Social Security, taxing the very same benefit the IRS already taxed once. That is the same dollar, taxed by the IRS, and then taxed again by the state. I am not going to give you a single national number here, because it would be dishonest. There is no universal state tax. It depends entirely on where you live, and the difference between the friendliest state and the harshest one, for that exact same couple on $6,000 a month, can be thousands of dollars a year. Two identical couples, identical income, identical age, can keep very different amounts of their $6,000 for one reason and one reason only. One of them lives on the correct side of a state line. Let me make that concrete with two neighbors, because this is where it stops being abstract. Picture two couples who work the same jobs, save the same amount, and now live on the exact same $6,000 a month. The first couple retired to a state with no income tax at all. For them, the federal number is essentially the whole story. The IRS takes its modest first cut and they keep nearly all of the rest. The second couple stayed in a state that taxes retirement income, including a slice of their Social Security and the full amount of their IRA withdrawals, same gross income, same age, same careful budget, but the second couple can easily hand over a few thousand additional dollars every single year, year after year for the entire length of their retirement. Over a 20 or 25-year retirement, that single decision, which side of a line your mailbox sits on, can add up to the price of a car or more. They did nothing different except choose a different zip code, and the system quietly charges one of them for it. I am not going to hand you a single national number for this, because there is no honest way to do that. There's no universal state tax. It depends entirely on where you live, on whether your state taxes pensions, whether it taxes IRA withdrawals, and whether it is one of the shrinking number that still reaches into Social Security. The only responsible thing I can tell you is this. You must know your own state's rules specifically, because the federal calculation we did is only ever half of your real picture. This is why I always say the number on your statement is not your income. Your income is what is left after the IRS and your state have both gone first, and the order is always the same. They go first, you go last. Reason number 3, the trap that hits you 2 years late. This one is sneaky, because it does not even look like a tax. It looks like a Medicare bill. It is called the Income-Related Monthly Adjustment Amount, and it is a surcharge added on top of your Medicare premiums when your income climbs above a certain line. For 2026, that line sits at $109,000 for a single person and $218,000 for a married couple. Now, our steady couple on $6,000 a month is nowhere near that, so you might think it does not apply to them, and in a normal year, you would be right. But here is the trap, and it is built specifically to catch the retiree who thinks they are being responsible. Picture that same couple, and one year they decide to do something smart. Maybe they pull a large lump sum from the IRA to replace the roof, or to help a family member, or they do a Roth conversion to get ahead of future taxes. Suddenly, for that 1 year, their income is not $72,000, it spikes. And if that spike pushes them over $218,000, even by a single dollar, they cross into the surcharge, and then comes the part nobody warns them about. This surcharge uses a 2-year look back. Your income from 2 years ago decides your Medicare premium today. So the big withdrawal they took this year does not hit their Medicare bill this year. It hits it 2 years later, long after they have forgotten the withdrawal even happened. They open a Medicare notice, see their premium has jumped, and have no idea why. For a couple crossing that first line, the surcharge can add well over $2,000 to their Medicare costs for the year. And it is calculated per person, on top of the standard premium, which in 2026 is about $203 a month each before any surcharge. It is a cliff, not a ramp. $1 over the line and the full surcharge applies. So the retiree living carefully on $6,000 a month is safe, right up until the year they make one big sensible move. That is the year the trap is set, and it springs 2 years later. And here is the part that turns the trap into a real wound. Most people assume that if the surcharge was caused by a one-time event, a single big withdrawal that is gone the next year, they can simply explain it and get it waived. They cannot, not for that. You are allowed to appeal this surcharge using a specific form for a genuine life-changing event, things like retiring or a permanent drop in income. But a voluntary choice, like a large IRA withdrawal or a Roth conversion you decided to do, is not considered a life-changing event. So you cannot appeal it away. You made a smart, deliberate move with your money, and the system charges you for it 2 years later and tells you there is nothing to discuss. Remember too that the surcharge stacks on both parts of Medicare. It adds to your Part B premium, and it adds to your Part D prescription drug premium separately. and it is calculated per person, so for a married couple both on Medicare, you pay it twice. 2 people, 2 surcharges every month. For the entire year, your old income haunts you. This is also why timing your withdrawals matters so much, and why pulling a giant amount in a single year can cost you in ways that have nothing to do with that year's income tax. The IRS and the system that runs Medicare are watching the same income number, and they are patient now. Here is something I want you to sit with for a moment, and be honest with yourself, because this is the whole reason I made this video. Have you ever actually run the gap between your gross retirement income and what you truly keep? After the IRS, after your state, after every one of these takers goes first? Drop a comment and tell me where you think you land. If you have never run it at all, you are in very good company, because almost no one has, and that is exactly the gap we are closing right now. Reason number 4, and this is the one that almost no one is talking about, because it has not happened yet, the timer. Go back to our couple and their comfortable $1,100 federal tax bill. Remember why it was so low. A huge piece of the reason was that senior bonus deduction. $6,000 per person, $12,000 for the couple. That single deduction is doing an enormous amount of work to keep their taxable income down in the bottom bracket. Here's the part you need to circle in red. That senior bonus deduction is temporary. It was created to run for tax years 2025 through 2028. As the law is written today, it disappears after 2028 unless the people in Washington choose to extend it. And history says you should not build your retirement on the assumption that a temporary tax break gets extended. So let us look at our same couple. Same $6,000 a month, same everything, but now it is 2029 and the senior bonus deduction is gone. Their deductions drop by that $12,000. Their taxable income jumps from about $11,500 to about $23,500. And their federal tax bill roughly doubles from around $1,100 to over $2,300. Nothing about them changed. Same income, same age, same state, same careful budget. The only thing that changed is the calendar. The low number you see when you plan your retirement today is sitting on a timer, and the timer is set to the end of 2028. After that, the IRS quietly takes more, and it will not send you a reminder that the rules changed underneath you. But here is the flip side, and it is the most actionable thing in this entire video, so stay with me. A timer that is counting down is also a window that is still open. Right now, today, you are inside 4 unusually generous tax years, 2025, 2026, 2027, and 2028. During those 4 years, a couple over 65 can have a remarkable amount of income sheltered by that stacked deduction. And that creates an opportunity that closes the moment the window does. Think about what that means. If you have a large traditional IRA sitting out there, every dollar in it is going to be taxed eventually when you pull it out, or under the required minimum distributions that start later, or by the person who inherits it. The question is never whether it gets taxed. The question is at what rate and in which year. These 4 years, with the extra deduction shielding so much, are some of the lowest rate years many retirees will ever see. They are the prime years to consider moving money out of a traditional IRA, either by spending it deliberately or by converting it into a Roth where it will never be taxed again, where it never triggers the torpedo on your Social Security again, and where it never counts against the Medicare surcharge again. The retirees who understand this are quietly using these 4 years on purpose, filling up that low bracket on purpose, converting on purpose, while the shelter is the widest it will ever be. The ones who do not understand it will coast through the window without touching it, and then watch their taxable income and their tax bill climb in 2029, wondering what they did wrong. They did nothing wrong. They just did not know the window was open, and no one came to tell them it was closing. And please do not build your plan on the hope that the window gets extended. Maybe the people in Washington extend it, maybe they do not. A responsible plan never assumes a temporary tax break becomes permanent, because the entire history of the tax system is full of breaks that were supposed to be temporary, and breaks that were supposed to be permanent, and the only safe move is to use what is in front of you while it is actually in front of you. This is the thread running through every single one of these takers. The Social Security tripwires that never move, the survivor's penalty that springs the moment a household goes from 2 to 1, the state line you may not even realize you are standing on, the Medicare surcharge that waits 2 years to strike, and the deduction that vanishes when the calendar turns. None of them announce themselves. The system is simply not built to warn you. The responsibility to see them coming falls on exactly one person, you. So let me put it all together, the way I promised at the start, because this is the number that actually matters. You start with $6,000 a month, $72,000 a year. That is the gross. That is the friendly number on the statement. If you are a married couple, both over 65 in a tax-friendly state, in 2026 the IRS takes a surprisingly gentle first cut, around $1,100 for the year, and you keep nearly all of your $6,000. That is the best case, and it is real. But the best case is fragile. Move to a taxing state and you lose thousands more. Take one big withdrawal in the wrong year, and a Medicare surcharge ambushes you 2 years later. Lose a spouse, and your tax bill can nearly triple on less income, through no fault of your own. And simply wait until 2029, and the federal bill on that exact same income doubles when the senior bonus deduction expires. The $6,000 never changes. What changes is how much of it survives the trip to your checking account. And the difference between the luckiest retiree and the unluckiest one on the identical income is not luck at all. It is whether they saw these 5 takers coming and planned around them, or whether they budgeted on the gross and got blindsided. And this is the mindset shift I want you to walk away with, because it is worth more than any single number in this video. Stop planning your retirement around the gross. The gross is the bait. It is the big friendly number designed to make you feel ready. Your real retirement income is one number and one number only. It is what lands in your account after the IRS, after your state, after the Medicare surcharge, after every taker has gone first. That is the number you pay your bills with. That is the number that has to cover the groceries and the roof and the trips, and is almost always meaningfully smaller than the gross you have been quietly counting on. When you build your plan on the net instead of the gross, 2 things happen. First, you stop being surprised, because you have already met every taker before they arrive. And second, you start to see the levers, the moves you can actually make, the conversions, the timing, the state, the window that change the net in your favor. Planning on the gross makes you a passenger. Planning on the net makes you the one driving. The entire purpose of this channel is to move you from the passenger seat into the driver's seat, one trap at a time. Here is the time-sensitive part, the thing you can actually do something about. The single most controllable lever in this entire video is the senior bonus deduction window. 2025, 2026, 2027, and 2028, 4 years. For people over 65, those are unusually generous years for pulling income out of a traditional IRA or doing Roth conversions at a low rate, precisely because that extra deduction is shielding so much of it. Once the window closes, that opportunity may simply be gone. The retirees who understand this are quietly using these 4 years on purpose. The ones who do not will look back in 2029 and wonder why their taxes went up. So here is your checklist, the simple version, the one you can actually act on. First, find out in real dollars how much of your Social Security is being taxed. If you're over the tripwires, and most couples on $6,000 a month are, the answer is a lot more than you think. Second, learn your own state's rules, not the federal rules. Your state. Find out whether it taxes your IRA, your pension, or your Social Security, because that one fact can be worth thousands a year. Third, before you take any large withdrawal, check the Medicare surcharge lines and the 2-year look back so you never trigger a surcharge by accident. Fourth, run the survivor's penalty now, while there are still 2 of you, because the worst time to discover it is the first tax season after a household changes. And fifth, use the deduction window, 2025 through 2028. Treat those 4 years as the gift they are, because the timer's already running. None of these 5 steps requires you to be wealthy, and none of them requires a finance degree. They require exactly one thing, that you stop treating your gross income as your real income, and start treating the net as the only number that counts. Do that, and you are already ahead of the overwhelming majority of retirees, who will live their entire retirement and never once run the calculation we just ran together. If you want help doing exactly that, this is where the Retiree's AI Research Guide comes in. It is built to walk you through running your own version of every calculation I did today, your benefit, your pension, your state, your withdrawals, your real net number, not a couple from a video. The link is at kevinretires.shop down in the description. And once more, so there is zero confusion, it does not replace a good accountant or financial advisor, and it is not meant to. It is the tool that helps you walk into that professional's office already knowing what to ask, instead of finding out 2 years too late. If this video showed you even one taker you did not know was reaching into your 6,000, do me a favor and hit the like button right now, because it tells the system to put this in front of another retiree who needs it. And if you have not subscribed yet, subscribe, because the next traps I am breaking down, the survivor's penalty in depth, the Roth conversion window, and the states quietly taxing your benefits, are the natural next steps after this one. So let me leave you with one last question to think about, and you can answer it in the comments. Now that you have seen all 5 takers, what does your real $6,000 a month actually look like after the IRS goes first? Type yes or no. Did this change the number in your head? I read them, and I will see you in the next one.